I'm Charlotte McLeod with investingnews.com, and here today with me is Peter Grandich of Peter Grandich and Company. Thank you so much for being here. Always good to be catching up with you.
Same here, Charlotte. Always enjoy it. Pleasure speaking with you.
Well, I think it's going to be an interesting conversation today. We're catching up from our last talk all the way back in December, so there's quite a bit to go over. And where I thought we could begin is with gold. I think it's top of mind for many investors right now, especially given the downward price activity that we've been seeing. So I wonder if we can begin there and get your thoughts on what is going on with gold right now.
So since we last spoke, when gold reached towards 5,500, I made a decision which wasn't popular at the time after many years of being a very strong bull on it because of the parabolic nature, mainly on how straight up it was going, and the sentiments was just off the charts of people's predictions, and just couldn't think it could only go straight up. I actually suggested and did get out of gold and silver and all my mining stocks but one. And since that time, I've nibbled back, but in the last couple of days, I have suggested that we're finally seeing the signs of a classic washout, heavy correction in a mega bull market. Sentiment is washed out. Technically, a lot of things are look bearish, and now we're approaching, I think, would be an absolute ideal zone that we're close to now, between 3,900 and 4,000. We may just need that little break below 4,000 when people see a hard number broken, they throw in that last towel. But, we're within $100 or $200 tops of a decline, and we still have a couple of $1,000s to go on the upside. So the risk reward now is returned more favorable, at least for me, in both gold and, surprising for me, silver, which was never a favorite of mine in all the years. It was always second rate to gold. It's actually performed somewhat better. And so that's why I think this has just been a heavy correction. Probably the silver decline was used by the heavy shorts to come out, forced or not, or a lucky break, whatever it was. But I think all the measures now that we would want to start to see come together for the end of this decline is before us.
Well, this is, I think, then the perfect time to be talking to you. So you exited almost completely, now looking to come back in. Can you talk a little bit about your strategy for re-entering the market, what that could look like, and where you'll be focusing?
So again, I'm not going to make the physical billion people the happiest people, although I'm bullish. I've never been, ever, even in my days of 100% activity in the metals market, a big believer in owning physical bullion for Armageddon or horrible times ahead. I've owned it when I thought it could make a capital gain, and I still believe that way. And because of that, I think in this next move up, shares, especially the producers, will actually give a better capital gain opportunity than the actual physical ownership of the bullion. I'm not against people owning it. I think there was a hard lesson learned in the parabolic rise and decline. People that own physical bullion suddenly ran into difficulty selling it because there was such an overwhelming exit that dealers weren't able to offer anything close to spot. Some were as low as 20% below, where those that had what, like people say, the proxies, or what the physical people say is not real ownership of gold, GLD and things like that, you were basically able to get out at whatever, spot was. So with that in mind, I do think you still need physical bullion to work higher in order for most major mining shares to do well. And therefore the 3,900, 4,000 is, to me, is the absolute bottom to this decline. I think if we got that below that 4,000 just for a brief period, it'll shake the last of the hardcore out. We may not even get there, but we're so close to it that I don't try to time it perfectly. And I've already started to acquire some shares again and put out some price areas where I would look to buy if we do get them down to those levels.
So we're getting close to that bottom level if maybe we're not already there already. What would you think will be the catalyst for gold to start moving higher? And maybe we can talk a little bit about where we are in the overall cycle for gold, because I know a lot of people looked at what happened in January and they thought that was the end. So how are you seeing it?
Well, the interesting thing about that is the things that drove us there still exist. They did not decline in any measure. The first and foremost is central bank buying. Yes, there's been probably a couple, so we know Turkey and a couple others because of the Middle East war. But China just continues to aggressively buy gold, and we see other central banks buying. So that's not a change in direction. De-dollarization is clearly continuing. And now, on top of all of this, something that you and I spoke to others with last year. I thought Trump last year in the early part of the year began to make a horrible economic mistake that would come back to bite him. I spoke about it often. One, the tariffs. He took a big stick into a trade war instead of an olive branch. And I felt that not only would the tariffs be reversed, but he would alienate our allies, even if they were deserving of it, even if all the people, including you folks in Canada that Trump treated us so bad and all this. Instead of going with a big stick and acting the way he did to them, I remember him saying he was going to break all the kneecaps of the BRIC members if they continue their way. He could have went and just said, listen, here's my olive branch. Things haven't gone great. We need to restructure this, but we need to find a way that it works for both of us. And because I believed he was not doing that, we would face a crisis. I didn't know what it would be. And I said our allies would not show up for that one. And sure enough, that's exactly what happened in the Middle East. No one's really come to our side or actively try to support our cause, even though it's in their best interest to see this solved because of the oil and energy crisis. So those things only are going to play favorable to gold. What people just need to understand is it went up so much last year. This type of correction is not out of place when something goes up triple digit within a year. It's just that there's always, if you've been a player of mining shares, particularly your juniors, you always feel like in the Charlie Bond character, the one where the cloud was always over you. And you just don't seem to have any length of time. But the constructiveness for what led gold to do what it did is still there. It just got way ahead of itself. So I'm not concerned about, that I somehow missed the bull market's over and we're just going to go completely lower again. And let's remember also, this has been happening at a time when something on Wall Street, I've been at this 42 years in and around Wall Street. And I never thought I'd see this day. And the days exist now for several months already. We have investment brokerage houses suggesting to people, and sometimes I have to slap myself, Charlotte, to believe it's actually happening, to own gold instead of bonds. That we actually have major firms in portfolios. The old 60-40 is now 60-20-20. That's amazing, but still private ownership outside of central banks in the world is less than 3% in gold. So there's still a tremendous upside for gold to become more part of portfolios. And I think as this mega bubble that is clearly leaking air now in the U.S. and the stock, it's already done that in bonds, that too will be favorable. And last but not least, crypto, which was stealing at least the mining shares in Junior's lunch, if not a little bit of Gold's lunch, that's also peaked and rolled over. NFTs have blown up. Mem coins are blown up. Now much of the cryptocurrencies are blowing up. So these things are all getting set to be turnaround positives for the next leg up in gold, at least in my view.
I think that makes a lot of sense how you're laying out those factors. One that I want to go back to for a moment is the Iran war, because I think it's been one that is a little bit confusing for people, where normally you hear gold is supposed to go up when you have times of crisis, which certainly that would be. But instead, we've had this downward and sideways momentum. So how are you looking at that? Does that make sense to you?
Well, I think it also happened at a time when that parabolic rise blew up and therefore it was going to go down anyway. And now it's going down when something should go up. So that's got to be bad. So it adds to the selling. But there's been liquidation. And quite frankly, that's some of the reasons several years ago why you bought gold at a lot lower prices, to have something like that available in that time of need and so forth and so on. So I don't get too caught up that it's not doing what it's supposed to do and all of that. The most important thing is the thing that drove us substantially higher. No one, I think, would doubt that, was central bank buying. That has not stopped. In fact, I think that we're going to learn and see that once this washes out, we're going to see more of them doing that. And we're also now also seeing finally some public interest in North America. It's not anywhere near like the demand in Asia, but at least now some financial institutions here are willing to look at gold ownership as part of a portfolio, which for most of my career, they treated it like kryptonite.
Definitely, that's a massive change that I'm sure we'll continue seeing develop. Going back again to the Iran war, it's created all these concerns about inflation. And I wanted to get your thoughts about inflation, higher prices. What is the outlook there? It definitely seems based on the latest US CPI data, these concerns are justified. I know that those numbers people often say are not reflective of the actual situation, but what are your thoughts on inflation at the moment?
Well, taking it at face value, you're absolutely right. To me, whatever I've seen, inflation always seems higher than what the government reports. But there's biases and reasons why governments, especially in the U.S., where benefits are paid out based on an inflation rate, there is a somewhat of incentive to goose it lower than maybe it really is. But having said all that, the CPI number that was out a couple of days ago would have been a lot higher, except for an extraordinary, crazy situation on car insurance that was so dropped dramatically that would have otherwise given the CPI as bad of a number as we just had in the PPI as we speak today. So the bottom line is inflation genie has been out of the bottle. As much as the government and Trump administration talked about how they were plugging that bottle back up again, it's not happening. And here's the other thing that isn't, maybe now in the coming days as we get closer to July, and people are going to start to realize that, hey, we discounted the war because we kept hearing from this president, it's about to end. I think they counted 37 or 38 times he's claimed that, the next day or two it's going to end. And so we haven't really priced in or really looked at what was still continuing from day one. And that was energy prices were working higher. Other things that are important, especially the food and all, were going higher. And now we have many months of that. And, the thing about price increases, it doesn't matter what industry or what kind of thing you're talking about. When people raise prices, they never really take it back to where it went to. Kind of stays up higher than where it was when they began rising the prices. So that's the other issue. Now, of course, we here in the United States thought with a change based on Trump that the new Fed governor would come in and he's going to dramatically lower interest rates and everything is going to be hunky dory. We already seen a Fed before the change where several of the board members were talking about at least holding strong, if not hiking, and none of the numbers out recently affords them an ability to cut interest rates here as well. In fact, I think if they cut interest rates, it would fuel the inflation speculation, where if they actually raised it, they might get a little bit more control of interest rates. But we also have a huge problem in the world that a lot of people are not talking about, and I would advise gold holders to take a serious look at it. And that's that bond yields are rising all around. We just had the ECB central bank raise rates. We have the Japanese yen back at a point now, which can cause a lot of problems for Japan. And these things are inflationary. They're not deflationary at this point in time. So I think inflation is going to be with us for quite some time.
Well, and as you're talking about inflation, and especially in the US, it will be with us for some time, and also talking about the gold ownership at the average person kind of level, do people really right now and in the future in the US, North America, do they actually have money to be buying gold and get into the market? Or how are you seeing that?
Well, that's an interesting concept for all financial assets. So let's spend a minute on that. So we just seen recently that the top 1% wealthiest Americans now own more than our entire assets than our entire middle class, which makes up about 60% of Americans. It's a very interesting argument to how this stretch is happening, especially when you look at the top 10% of all Americans own 86% of all the assets. The next 40% of wealthiest people own the remaining 14, and half of all Americans have no assets. In fact, half of those folks, or 25% of all the workforce, are now using some sort of buy now, pay later process, either through credit cards or these groups that allow you to do that and all. And so the question is, how much room do they have to expand, either being able to pay higher taxes or pay for things and all? But it's the upper echelon which really influences the market and has moved the market. They have not been hit yet, but there's still tens of trillions of dollars in the world floating around in pensions, insurance companies, and so forth. And like I said before, gold is not heavily overly owned by those groups. It's not going to be one of the first places people run to get out, because there's not a lot to get out of. But like I said, the single most important thing for gold is continuing central bank buying. And we need to then ask ourselves, Charlotte, go back, please let me take a minute on this, is why did they make such a switch? Why were they once such aggressive sellers, and then over the years, especially the last few, become aggressive buyers? What they're buying, not going to have the ability to sell to somebody else and make money on it. They're buying it for an actual usage and a reason, and that is the continuing moving away from the United States economically and its system, and using other systems and not using the U.S. And that's only continuing. Right now, the BRIC nations, they're still moving forward. They're just not out flaunting it, because they know come this November election, anything left that Trump could do them to stymie them or hurt them could be over, especially if he loses one or both the houses. So those things are still moving. They haven't changed direction. And that's why I go back to our original concept that this is just a hard correction in the metals, not a change in a long-term direction.
That's really interesting. You're right. I haven't seen any huge headlines lately about the BRICS. So they are just lying low right now, seeing how those elections play out. And then maybe we see some more news about what's going on with them.
Yeah, well, if you think about it, he literally was saying multiple times last year that he was going to break the kneecaps of all the BRIC if they didn't conform and do all these changes. And if you look at all the supposed trade deals that were done, and it was going to all be good, if you remember those constant social media put out by Trump's, none of them have really gone through fully, and others have, broken up. Now, of course, he's saying he's not going to trade it all with Canada or Mexico and get rid of it. All this blows up on him if he loses the House and or the Senate. And the House is such a thin margin now. And when you look at the polling now on Trump's numbers, you have to take a serious consideration whether you like it or not. If you're a Magna or someone like me that's kind of middle of the road, there's a real strong chance that one of those houses could go the other way. And if it is, you can just, if you thought it was bad during his first term, how the Democrats fought him having some control in one of the houses, I can't imagine, in both houses back then, what it would be like this time around. So that's why I think places like the BRICS and all, they're moving forward. They're still doing things, but they're not pounding their chest openly, because they don't need to stir the bull any more than he's already kind of running around crazy already, Trump. So.
Yeah, there's enough internal turmoil, and it sounds like there could be more coming down the line as the year continues. On a more immediate note, I was wondering if we can take a look at the next Fed meeting. So we have that coming up next week, and it's going to be the first with Kevin Warsh at the helm. So you talked a little bit about the direction of interest rates potentially in 2026, but what will you be watching most closely at that meeting, maybe in terms of the commentary, because it's always so important to read between the lines?
Well, the actual wording that the Fed puts out will be looked at, and of course, his first press conference. Let's not forget that Trump, before all this, said, as soon as he gets in, now his comments have become much softer, although that can change overnight. I'm hoping over time he will work that way, or something, paraphrasing what he most recently said. I think at the very first meeting, we're not going to see any change, especially with the most recent CPI. There's no rate cut coming. There's not. It'd be the biggest shock ever in my 42 career on anything if there was a rate cut. I also don't think there's much of a chance of a rate hike here, because it would be like, hey, you didn't even give a chance to get, your foot on the ground and you're already raising rates. I think the wording and the little differences that people may see. And let's not forget, as we went out with our last chairman, we had some record breaking where we had such discrepancy, but from a few Fed governors. If that stays, or even one more goes a different way, then there could be real concerns that the Fed has a split among it and may not be able to do what is needed, either raise rates or lower rates, because there's such a difference of an opinion. So it's not going to be as boring as some people are talking about, but it's going to be watch words and actions versus deeds, what people will be looking at.
I think it'll be really interesting to see how it plays out. So we'll keep an eye on that. And maybe we can take a step back and talk about what these circumstances that we've been going over mean for the overall US economy. I know in the past you've expressed some real concerns about where we could be heading. How is it looking right now?
Well, like I said earlier, for small upper echelon Americans, things are going pretty good, up until most recently now, because some of the things are starting to change direction in the stock market, and some numbers are coming in, with private credit and equity not doing as well as they thought it would be. They were not able to offload it to the public because they were hoping with Trump's push to get the public into this market. But outside of that, the vast majority of Americans are struggling to stay afloat, and we're seeing a lot of issues where we just see now wage growth actually declining. And so these are things that don't bode well. The shock that, and when, I'll just put on my business hat just for a minute, and what remains in the planning group I'm part of. And I asked these people, your current advisor and all, do they talk to you about the debt in the United States? No, not really. They say it's okay, and we can always print money, and, these answers I get back. And I said, well, listen, we're at $39 trillion now. Now, understand this. We went from 1 trillion to 10 trillion. It took 26 years to do that. From 10 trillion to 20 trillion, it only took 12, so less than half. And from 20 trillion now to 40 trillion, it'll only be 6 years to do that. You can't keep that level up. Even the Congressional Budget Office, which just a few years ago forecasted 50 trillion by 2035, now they're at 67 trillion for a debt level. I say let's just stay at the 50 because it's easy for people to understand it. And let's just put an interest rate of 5%. That's not a high historical number. We would have a 2.5 trillion interest expense yearly in the United States. The best this country's ever taken in revenue income was a little over 5 trillion in 2024. Half of all our income will go just to pay interest. We will not have a government that we've grown used to provide the services and all, if that's the case. And keep this in mind. This is really surprising, even when you talk to younger advisors who aren't even aware of this. The single largest asset that the United States has on its books is student loans. It's been about, call it 25% now, to call it an easy number, of all our assets. 13% of all student loans right now are almost in default. They're way behind in payments, et cetera, et cetera. Whether or not, like Biden group talked about, forgiving all, if parts of those student loans aren't paid back, that's income that America was expecting to have going forward. Without it, they have to raise even more taxes. And when 2/3 of Americans, Charlotte, are working paycheck to paycheck, there's not a lot of room to raise a lot of taxes on those people. The extremely wealthy always find ways to not have to pay as much as maybe they should. And so the bulk of the working class in America are likely now to face even a more burden on them, economically, socially, and politically. And that doesn't bode well for a strong economy. That's why I have such a bearish outlook longer term, and that the time is coming very soon. It's in most lifetimes. Listen, We just had in our Social Security uh, trust funds come out and say now that the new study is that they're going to run out by 2034 now. Not 20, it used to be 2036, and it was 2035, 2034. The Medicare and Social Security trust. 60% of people collecting Social Security right now, obviously seniors in America, it's their sole income. So they can't even begin to think of they're talking about a 22% as a number floated around, having to cut it. So what will some of the government have to do? And they'll wait, of course, till it's too late, but they'll lower the level of amount of money you can earn or have in order to still collect it, because somebody still having $1 million or $2 million or earning it can get by without their Social Security check, but these other people can't get by at all. They're going to stretch out the time of date when you can either collect it, and then they'll keep taxing higher and higher the working class that they can with a higher tax. All of this is bad for the economy. And that's at a time when 25 of our 50 states can't even balance the budget. They're all running deficits. And they don't have a printing press as the United States does and all. So there's a lot of economic pressures coming for the average working American that may have not existed a generation ago. That's another reason why I don't have such an extremely bullish economic outlook, especially when our stock market valuations went off the charts and people were paying just, ridiculous valuations on, things were doubling or tripling in a month, and businesses just can't sustain growth like that. So I just think it's going to be a lot more challenging for several years to come.
I want to follow you over to the stock market in just a moment. But before we do, there's this idea about gold revaluation that I've heard about. And some people say, well, maybe this can help with the economic situation in the US right now. Maybe if they do that, it'll make things a little bit better. Is that something that you subscribe to or think could happen?
So the lead advocate in that is a woman, Julie Selden, who's talked about come this July 4th, Trump is going to issue 50-year or announce 50-year Treasury bonds backed by gold. So my concern about that, and maybe I do play into the gold crazies or gold hardcore people when I say this, and that is a year ago or so, Musk, for about 2 weeks, along with Trump, almost made daily social comments on they want to go to Fort Knox to audit the gold. And we all assumed, which rightfully so, was the only reason they would want to do that is because they're going to plan on using it somehow. And then it went completely off the radar. Was never spoken again. Nothing was ever said. And I have jokingly to my clientele and readers and said, I think because somebody came in the room and go, Mr. Trump, I don't think we want to do that. There's always been an argument, and I think a strong argument, started by Ron Paul Sr. originally. And that is all the gold in Fort Knox? And even is it all real, or is part of it, some of it has been really owned or lent out more than once, whatever. And my simple argument was to that they have an argument, those people that make that conspiracy stuff, is if it's all there and we know it is, get rid of that thought. Go in and do a full audit. Show everything is fine. He said it again now. The only thing I'm concerned about is I would hope from a business standpoint, if we are doing this come July 4th and we are going to offer our gold out backing bonds, maybe we should have done the audit before then just to make sure we have what we have to do that. Because nothing would be worse if we do float a bond issue and raise, hundreds of billions of dollars or $1 trillion, whatever, and then finally get around to go over there and find out we don't have all the gold we'd have. That would be a nightmare scenario. So, I don't know what will come of that, but I do think I would have felt better by now if it was happening July 4th. Some other people would have leaked it because they want to show that they're in on the inside and all. No one else has really talked about it other than her. Maybe it's her belief and hope, but even if it happens, I don't think it radically changes the course economically for the United States.
Really good overview of that. And you're right, that would be a total nightmare scenario. So I hope we don't end up seeing that play out. If we go over to stocks and bonds, I know you're very, very bearish. You've talked about this online. We've spoken about it in the past. And I've seen a few recent interviews of yours where you talk about actually shorting the stock market. So I wanted to ask, is that something that you're still doing at the moment? What's your strategy there right now?
So a couple of weeks ago, I talked to people and said that I'd taken an aggressive short position in the stock market because of this factor. A long time ago, a financial mentor who I was once pitted on my early career on a TV show down here and became my financial mentor. He came up with an answer that almost all retail people ask financial people, but feel they never get the proper answer. And that question is, how come you people always tell us when to buy, but you never tell us when to sell or to sell at the right time? That's a standard comment I've heard from retail, not really directed at me, but I've heard from retail people for decades. And his answer was, a genie pops out and has this bag of money and says to you, you can take this bag of money and put it in a stock that you're talking about, or all stocks, whatever, or you can keep it completely out from it. You can do one or the other. Peter, he said, if you can't take that found money and put it into the stocks you own, then you need to ask the question, why do you still own them? And it got to me a couple of weeks ago in the stock market. I couldn't, with found money. I've told clients, most didn't want to hear it, especially our new prospective clients. I couldn't begin a stock U.S. equity general portfolio now if my life depended on it. Now, there's somebody out there that thinks the exact opposite. That's what makes markets. So the stock market to me is not a place that I would look for long-term capital appreciation. I think something else is important. Again, this is something invoked at our planning group, and that is capital preservation now needs to be more important than capital appreciation. I've seen over the years, Charlotte, again, it could be just one person's view, but I've seen most of the people that made good sums of money over time, it wasn't how much they made, it's how much they didn't lose versus others, which made them wealthier than others. And I think that's the attitude we have to have now. Not so much focusing on how much we can make, but how much can we protect ourselves from some potential, losses. And one of those places for me a couple of years ago was the bond market, and I got out. The second now is the stocks, and all along this time was crypto, from NFTs to meme coins to crypto. You know that I was extremely bearish on that in 2 years, got a lot of abuse from it. But there, now we find a lot of, especially retail people, have suffered large scale losses there. So I think the stock market is more of a place of be a live chicken versus a dead dog. Will there be certain sectors? Yes. Is there better stock markets than others? Yes. If I have to invest based on region, Asia has much more of a chance to move forward as a group economically than here in North America, and especially Western Europe. The EU is done. They just haven't told anybody yet. The European Union will come apart in some way, shape, or form. Either try to restructure or start to see members pull. Western Europe has no advantage to be a strong equity investor, especially since where the valuations are on their stock market. Yet places like Vietnam, Singapore, even China, I would invest in before I would invest in the US or the German market or the UK or other places like that.
That makes a lot of sense to me. I wonder, this is a little bit of a tricky question, but do you have any sense on timing here? Because I think a lot of people, especially in our audience, believe this rise in the stock market can't go on forever. And indeed, I know we're seeing declines at the moment, but still historically so high. So do you have any sense on when we could have that turnaround, or is it something that we can't say?
So as if you were a prospective client that just came in my office and asked me that, this is the answer I would have given you, and I'll give it to you here in your show. One, those of us that live looking into a crystal ball, the only thing we become experts over time is how to eat broken glass. The only person that knows the future, Charlotte, is God. So the only thing I could do, maybe after 42 years, is make an educated guess. That's the first thing. The other is there was a phenomenal newsletter writer in my history, 3 or 4 best ever. His name was Jim Dines. James Dines. He's passed away several years ago, but he was a phenomenal guy and just an historic. And he had one of the best lines. He says about market timing. He says, just remember the poor guy that invented preparation G, because it was preparation H that made it. And what he was pointing out is that timing is very difficult. That's why I'm always concerned when people first talk to me about trading futures, because you could think that the right move, but you can first get a backwards move against you before everything goes your way and you're out, And then, of course, the second most riskiest is things like options. Having said all that, and putting out an asterisk that I lost enough money over the years trying to trade, I would just tell you that the likelihood is, chances are, we have seen or are within the ultimate highs for a period of time because of all the pressing economic, social, and political issues that are happening. What's the 2 things that could make me wrong? See, we never hear advisors talk about how could I be wrong, because they're like Fonzie from 50 years ago when he couldn't say I was wrong. Here's where I could be wrong about my stance. 1, the market has changed 180 degrees from when I entered Charlotte in 1984. In 1985, 90% of the trading in the stock market was retail investors. Only 10% was institutional, and there was no computer trading at all. In fact, there were only 3 exchanges, the New York, the Amex, and the NASDAQ. Now, almost 60% of all the money in the stock market is in passive funds. And please allow me a minute to, this is really, real important in my view. So now we have a system where more than half of all the money that's coming into the market is being turned over to managers where he or she have no real discretion other than their job is to take that money and match the performance of what it's being matched against. And the most popular one is the S&P 500 index. So when that money comes in, he or she needs to proportionally buy the stocks so that if the index goes up so much, these stocks will kind of match it and so forth. And it's been a self-fulfilling prophecy because more money's continued to come in. Passive fund investing has grown, caused those stocks to even do better than the others, causing more interest to want to be into passive funds. It's not a Ponzi, but it was more of a self-fulfilling prophecy. The problem is then when you take the remaining amount of the money, when you don't count that, 2/3 of that is in some type of algorithm trading programs. In fact, Trump took advantage of this during this middle crisis by timing his comments about supposedly good news coming on the war, because the algo computer programs are just trained to pick up words and news stories and then based how the artificial intelligence been trained, whether that's good or new, buy or sell stock futures. And because it was potentially good, they triggered buying stock futures. That's why we saw stock futures overnight come into the U.S. market so high already. And then because that happened, then there's another group of algo traders that trade based on how stock futures themselves are performing. So the causing going up makes them buy too. So it's been a different atmosphere and so forth and so on. If that continues and there's not a reason for that to switch, then I will end up wrong because that will just keep propelling it up. The other thing, which is on the fence now, and this eliminates invitations to me to Christmas parties at brokerage firms, but 2/3 of financial advisors, over the 300,000 licensed financial advisors in the U.S. right now, and not all of them are actually giving advice, some are working behind the scenes, what have you, but the vast majority have not been working when there's been a bear market, meaning they've been employed since 2008. The COVID was over before it began. That wasn't a true bear market. And they have rightfully, they themselves and their clientele that they built, hey, you got to buy every pullback because every time it goes down, it goes back up. They don't know what a bear market is. I like to say that they've learned how to drive on a one-way street. Now, we all didn't do that. We learned. But imagine if that's all you learned. Well, hit the gas, go. And an odd time, there was a bad accident. This Fed tow truck came along, threw a bunch of money on the road and made everything well. That is changing. And if that bear market returns for whatever reason, I don't believe we have the professional wherewithal to do what's necessary during a normal bear market. As much as we got overdone to the upside, I think because of this lack of experience, both among investors and the so-called professionals, we'll get more to the downside. And then if the switch comes on the passive funds and they no longer flow out, remember, as those people start to sell, the manager can't say, no, you're making a big mistake. That's a good no, they have to do that and all. So those are the biggest things, those two that can go either way, whether or not my overall bearishness will prove correct or not.
I think it's always good to go over what could be wrong with your line of thought. So thanks for walking us through that. And I'll let you go in just a moment. But before we do, I want to spend a little bit of time on copper, because we talked a little bit about what's happening with gold and silver, but I saw you post on X that copper is actually your favorite metal. So I know copper has such a long-term positive outlook, but these economic disruptions that look like they're coming down the pipe, a lot of people are concerned about what that could mean for the metal. So what makes copper your favorite right now?
So you're right. Several years ago, five maybe, I'm trying to think about that. I became bullish on it because of all the changes. And copper, and people still like to use this saying it's Dr. Copper. And if, the economy gets weak, copper is signaling that and it goes down. That was when there was ample supply. It isn't there anymore. So that isn't the case. There, if I may, to your audience, Robert Friedland, who's a well-known, one of the top 5 to 10 best-known people in the metals and mining industry, a billionaire, highly successful in this industry for decades, has a wonderful 4-minute video that everybody should watch. He speaks at what's called the Energy Summit. You just go out and put Robert Friedland Energy Summit and you'll come out. And in his 4 minutes, he describes exactly why copper is the best metal to own going forward. In my opinion, it's his, but I also think uranium ranks that as well. But as far as copper is concerned, there is we need, according to Friedland's work, and I've looked at it and I concur with it, we need 6 tier 1 copper mines to come online every year now for the next 25 years to match the demand without taking in artificial intelligence and electrification. Just regular growth that is to occur. Several things that have happened in copper. One, the areas where you can go find it are not as available, or where big mining companies are willing to go. And even if they are, like a place like Chile, where almost 25% of all copper comes from, have all sorts of issues. Grades are dropping. Energy cost to look for that copper, to bring it out of the ground and all, is going way up and all. So the bullish scenario for it, as I called it, the turtle among the rabbits, of gold and silver, was just work higher. And until we get to a level, which many say will be somewhere between $7 to $10, and stay there for a while, big major mining companies are not going to throw a lot of money, because the world has shrunk economically, socially, and politically where they're going to be willing to go. And that's why I believe it has a much longer stable rise in it. The uranium market, which I'm not in, at one time I was a big uranium bull, but the stocks got way ahead of themselves. The uranium physical argument alone is the best argument, because we're now seeing wind, throw it out, all sorts of problems with it. Solar, starting to have problems, build these big farms. Storms come, they're destroyed and all. Uranium and nuclear power, especially the electrification, if it continues to where we're having massive brownouts and blackouts, because the grid in the United States is so old that I like to joke that Thomas Edison installed some of it. So not only do we have to spend a lot of money upgrading the electrical system here in the US and maybe in Canada, I don't know about Canada and all, but the demand for electricity and the cost are going up so prohibitively. And the only long-term answer for that, and this is somebody that's not touting anything, I don't own any nuclear stocks or uranium stocks or anything at the moment, but it has the single best argument. But it has one negative, and people don't like it when I say this, even when I was bullish. Unlike all other metals, gold, silver, copper, lithium, whatever. There's dozens, if not hundreds of producers, public companies that you can invest in. In uranium, you can count them on both hands. The rest are exploration companies who may or may not find it. And if they do, may not find it and get it to where they can sell it in time to take advantage of this demand. So uranium physically has as good, if not better, supply and demand argument. It's just that the shares, A, it got ahead of themselves, and B, there's not a lot of variety that you can get involved in that market. And I know at one time we spoke about uranium.
We did, and our audience are fans of uranium. So for you, would you ever go back into it if those stocks pulled back enough that you thought it was worth it?
I just started to track them again because they've come off enough. The negative is for the producers, they're going to be tied to the stock market. And since I think the stock market has more of a potential decline in it than a rise, they still may be dragged down, even though the argument to have nuclear is only going to grow over time. They're just, they're coming back to an okay level, but they're not at, wow, I got to grab some yet, in my view. And, if somebody said, is there a number? Probably 10 to 20% lower, probably gain my interest again. But I will tell you this, long term on producers, it's going to be hard to lose money because we have to. And I'm talking about a generation now. I'm talking about 10, 20, 30 years out. Peter's likely to be long gone by then. But for those that are thinking that way and going to be around for that time, nuclear has to become more and more of the power source in the world if we're going to have all these things in data centers and all electrical cars and all this other stuff.
Absolutely. I think that's one that definitely seems inevitable coming down the road. All right. Well, this has been really good. I think we covered quite a bit of ground here. I'll let you go. Just before I do, any final thoughts that you want to wrap up with, leave investors with at the moment?
So I've had to share this saying of mine at this time because we're really at critical junctions in markets. And I tell people when they come in and sit with us in our planning group that the ultimate crime is never being wrong. I've been wrong enough times. I talk about it openly. A lot of people don't. You would think most people never lost money that worked on Wall Street. But the bottom line is the ultimate crime is never being wrong. It's staying wrong. And the way you have to look at it is hope is a wonderful personal strategy to have, spiritually and all. But it's the worst investment strategy to have. And what I still hear from people, even now that have juniors and all, who have said to me, I just hope it goes back so I can get my money back. Hope has its place, but not in the investment world. And so those two things, err on the side of caution, live within your means, because 7 out of 10 Americans live beyond their means. And that's why we have such debt and issues and all. And recognize that taking care of more important things. Debt is a dirty 4-letter word. I've never met anybody yet, Charlotte, and it's been a crusade of mine for 25 years to get people to be debt free or less in debt. I've never met anybody that went debt free and said, man, that was a mistake. I was much better off when I owed a bunch of money. So that's another thing that I would suggest people to consider.
Okay, well, really good words to end on. Thank you so much for coming on today and going over your thoughts. This is really valuable for me and I think for the audience as well.
Thank you as always, Charlotte. God bless you.
Of course. And once again, I'm Charlotte McLeod with investingnews.com, and this is Peter Grandich.
Thank you for watching. If you like this video, make sure you hit the like button and subscribe to our channel. We'd also love to hear your thoughts, so leave us a comment below.